Next, we're going to talk about errors and how those are handled. Now, while we cannot absolutely cover every possible error that might happen, we talk about them from a more broad perspective. FASB requires the correction of errors be treated as prior period adjustments and recorded in the year in which the error was discovered and reported in the financial statements as an adjustment to the beginning balance of retained earnings. If comparative statements are presented, the prior statements affected should be restated to correct for the error. Managers might have a variety of motives for reporting the income numbers that they do. Research shows that some of these reasons can involve political costs, capital structure, bonus payments, the smoothing of earnings. To counter these procedures, these pressures, FASB has declared that they will assess proposed standards from a position of neutrality. Some of the types of accounting errors are a change from an accounting principle that is not generally accepted to an accounting policy that is acceptable. Mathematical mistakes, changes in estimates that occur because the company did not prepare the estimates in good faith, failure to accrue or defer certain expenses or revenues, the misuse of facts, the incorrect classification of a cost as an expense instead of an asset, and vice versa. The types of restatements that may occur. If it deals with expense recognition, we would need to record the expense in the incorrect period or could be for an incorrect amount. Revenue recognition could be instances in which revenue was improperly recognized, questionable revenues were recognized, or other numbers of related errors that could lead to any misreported revenue. Misclassification includes restatements due to the misclassification of short or long-term accounts, or those that impact cash flows from operations. Equity errors, improper accounting for EPS, restricted stock, warrants, and other equity instruments. Allowance or contingency errors are errors involving accounts receivables, bad debts, inventory reserves, income tax allowances, and loss contingencies. And long-lived asset errors deal with asset impairments of property, plant, and equipment, goodwill, or other related items. So as you can see, this is on the general side to kind of see where it falls. Taxes errors are errors involving correction of tax provisions, improper treatment of the tax liabilities, and other tax-related items. Equity and other comprehensive income are the improper accounting for comprehensive income equity transactions, which can include foreign currency items, minimum pension liability adjustments. You just recently learned about those. Unrealized gains and losses on certain investments and debts, equities, and derivatives. Inventory errors such as costing valuations, quantity issues, and cost of sale adjustments. And equities related to stock options, such as the improper accounting for the employee stock options. And last but not least, other, which is really any restatement that is not categorized or covered in one of these listed categories. All material errors must be corrected. We record the correction of those errors from prior periods as an adjustment to the beginning balance of retained earnings in the current period. These corrections are called prior period adjustments. And when there are comparative statements presented, a company needs to restate the prior statements affected to correct for the error. So to illustrate this, let's look at in 2018, the bookkeeper for Selectro Company discovered an error. In 2017, the company failed to record $20,000 of a depreciation expense on a newly constructed building. This building is the only depreciable asset Selectro owns. The company correctly included the depreciation expense in its tax return and correctly reported its income taxes payable. Selectro's income statement for 2017, with the error, gave them net income of $60,000. Without the error, it would have only been $48,000. So what are the entries that Selectro should make? And did they make for recording the depreciation expense and income taxes? So the entries the company did make was that they left off the depreciation, and they had an income tax expense of $40,000 with a deferred tax liability of $8,000 and income tax payable of $32,000. Without the error, what they should have done is they should have had the depreciation expense of $20,000, offsetting accumulated depreciation of buildings contra account of $20,000. They'd have then had a $32,000 income tax expense and $32,000 to income tax payable. So the income tax effect is the depreciation expense for 2017 is understated by $20,000. The income tax expense in 2017 is overstated by $8,000. That's the $20,000 times 40%. That's their tax rate. This resulted in net income that is overstated by $12,000. On the balance sheet, the accumulated depreciation account buildings is understated by $20,000, and the deferred tax liability is overstated by $8,000. So you can see how it's very important that we take all of the different impacts into consideration. Once we have something like depreciation that wasn't entered, then we need to figure out what its tax effect would have been and what that would have done to the income tax expense tax entries. So to prepare the correcting entry in 2018, we start with what the impact to retained earnings is, which is $12,000. We have to reverse out that deferred tax liability. We need to recognize the accumulated depreciation on the building. Here we show the single period statement with the correction of the error. Selectro had a beginning balance on January 1st, 2018 at $350,000. And then the company reported $400,000 of net income in 2018. In order to account for the impact of this error, they would note correction of an error for depreciation of $20,000 less the applicable income tax reduction of $8,000 for a net $12,000 reduction to the retained earnings. When comparative statements are being presented, companies need to make the adjustments to correct for the amounts for all affected periods that are reported in the statements. They restate the data to the correct basis for each year that's presented. They show any catch-up adjustment as a prior period adjustment to retained earnings for the earliest period it's reported. Let's take a look at the statement of retained earnings, December 31st, 2017 for Woods Incorporated. Before issuing the report for December 31st, 2017, You discover a $62,500 error that caused the 2016 inventory to be overstated. Overstated inventory causes cost of goods to be lower, and therefore your net income will be higher in the 2016 period. Would this discovery have any impact on the reporting of the statement of retained earnings for 2017? Yes, it would. And we're going to assume that there is a 20% tax rate. We start with our $1,050,000 balance from January 1st. We recognize a prior period adjustment net of tax of $50,000, giving us a new balance on January 1st restated of $1 million. We then have current period net income less current period dividends to give us a balance on December 31st of $1,060,000. Remember, we need to do things net of their tax effect. That is where you will make your mistakes, is forgetting about the tax impact. So remember, with your changing in accounting principles, that's a retrospective approach. And here are some of the key things that you should keep in mind. Now, if the change is due to an error, that's when we have restatement that comes into play. Some of the motivations for changes of those accounting methods is that companies may choose things due to political pressures, the capital structure of the organization, bonus payments, smoothing the earnings, sometimes outright fraud. And now, but last but not least, let's analyze the effects of some common errors. Errors occurring in the accounting process can result from mathematical mistakes, bad faith accounting estimates, misapplication of accounting principles, and a whole lot of other causes. The profession requires that the errors be treated as prior period adjustments and be reported in the current year as adjustments to the beginning balance of retained earnings. Companies have to answer 3 questions. What type of error is it? What entries are needed to correct the error? And after discovery of the error, how are financial statements to be restated? Companies treat errors as prior period adjustments and then report them in the current year as adjustments to the beginning balance of retained earnings. Balance sheet errors affect only the presentation of an asset, liability, or stockholders' equity account. If there's current year error, we reclassify the item to its proper position. If it's a prior period error, we restate the balance sheet of the prior year for comparative purposes. With income statement errors, the improper classification of revenues or expenses. If it's in the current year, we reclassify the item to its proper position. If it's from a prior year, we restate the income statement of the prior year for comparative purposes. Remember, you're also going to need to look at aspects such as tax. Counterbalancing errors are errors that occur in one period and correct themselves in the next period. If a company has closed the books, if the error is already counterbalanced, there is no entry that is necessary. If the error is not yet counterbalanced, we make an entry to adjust the present balance of retained earnings. For comparative purposes, restatement is necessary, even if a correcting journal entry is not required. The company has not closed the books. If the error is already counterbalanced, make the entry to correct the error in the current period and to adjust the beginning balance of retained earnings. If the error is not yet counterbalanced, make entries to adjust the beginning balance of retained earnings. Non-counterbalancing errors take longer than 2 periods to correct themselves, and sometimes may exist until the item in error is no longer a part of the entity's financial statements. Some examples of non-counterbalancing errors: a failure to record depreciation, recording a depreciable asset as an expense, recording the purchase of land as an expense, recording the discount on bonds as an interest expense in the year of issue. Companies must make the correcting entries even if they have closed the books. So let's look at this partial trial balance for Julie Harstack Corporation on December 31st, 2018. We're going to assume the books have not been closed. What are the adjusting entries necessary at December 31st, 2018? Give you just a minute to peruse this. So assuming that the books have not been closed, some of the adjusting entries would be for supplies. A physical count of supplies on hand totaled 1,100. So we would have a supplies expense of 1,600 against supplies of 1,600. There is accrued salaries and wages on December 31st, 2018 in the amount of $4,400. We need to recognize salaries and wages expense, $2,900. Mind you, coming back, there's $1,500 in there. That's why it's $2,900. And then salaries and wages payable of $2,900. Accrued interest on investments amounted to $4,350. So need to recognize interest revenue in the amount of $750. Of a reduction because we have it at $5,100. And we post that to our interest receivable of $750. The unexpired portion of the insurance policies totaled $65,000, meaning there was $25,000 that expired in insurance expense in this current period. $28,000 was received on January 1st, 2018 for the rent of a building for both 2018 and 19. The entire amount was credited to rental income. We would recognize rental income of $1,400 in 2018 and unearned rent revenue against unearned rent revenue, which is your liability account. Depreciation for the year was erroneously recorded as $5,000 rather than $50,000. So we recognize an additional $45,000 of depreciation expense against accumulated depreciation. When the books haven't been closed, it's much easier to correct these problems. That's why it's so important to comb through the trial balance multiple times, and the reason we look at it so many times before we close the books. Here we have Dixon. Assuming the books have been closed, what are the adjusting entries necessary on December 31st, 2018? There has been supplies used, so we would have to go to retained earnings, $1,600, supplies, $1,600. We would have the $2,900 in accrued salaries. Would need to go to our retained earnings and salaries and wages payable of $2,900. The accrued investments on the amounts to $4,350 means that we would debit our retained earnings, $750, and credit that interest receivable by $750. And then the $25,000 in insurance expense, we would post $25,000 to retained earnings, $25,000 to prepaid insurance. $24,000 was received. The entire amount was credited to rental income. We would credit retained earnings, or sorry, we'd debit retained earnings, and then we would credit unearned rent revenue. The depreciation, we would debit $45,000 to retained earnings and $45,000 to our accumulated depreciation. Occasionally, we might have to change from one method to another. When that occurs, you'll see that in your appendix, there's a bit of a juggling act that you need to go through in order to ensure that everything across the board remains transparent.